Hi, this is Ralph Mendez, and we are going to talk about Chapter 20, budgeting. So let's see if we can stop this, stop recording there. All right, and let's share my screen. So we're going to do Chapter 20. And the first thing they want you to do is the production. So how many do we need to produce based on this amount of sales? But let's back up. Why does budgeting matter to y'all? Do y'all think that y'all are going to be involved with budgeting sometime in your life? Well, I would like to share with you that I believe you will, regardless of where you are, where you work, or even in your personal life. Now, if you don't like the word budget, my wife doesn't like the word very much. So to me, it's a spending plan. It's a plan. And that's what's the beauty thing about it. You figure out things. It makes you think about these things. So based on this sales, we have to produce this many. And based on this many, we need to have this much materials. And based on this much, we have to have this much labor. So there's really a process to this. And based on that production, you have this much overhead. So there's really a beauty to it in that it makes you think and plan. Now, in your government, I'd like you to know this for the rest of your life. You have two budget offices up in Washington. And I don't know why, I'm not your government teacher, but does it make me wonder they don't trust the other one? So here, for the president, you have the Office of Management and Budget. But if you go right now, since President Biden's been in office just a short time, it won't find it there. See, he has 22, which is not due till next summer, I think September. So you're not going to find it there. So if you go to fact sheets or whatever. Now we're going to go to historical tables, and we're going to go to receipts by source since 1934. But before we do, I want to go here. Congressional budget. So the Congress has its own budget office. So here it is, the long-term budget outlook, projected acquisition costs for the ground combat vehicles. Now, so let's see. I want to go to the long-term budget, and I want to share with you right here. Deficits. Right here we are. Look at the trend the next 20 years here. The deficits, as you can see, the COVID has wreaked havoc. Here's the recession when y'all were about 8, 9 years old, right here. All right. How about federal debt held by the public? World War I, the Great Depression, World War II. And we had a great expansion. Grandparents, Great Depression 10 years ago. Now the pandemic right here. And look what the projection is. And that's why I was, all right. CBO, Congressional Budget Projected of Outlays by Component. So here you have major health programs, net interest on the debt. There's the health programs, the interest on the debt, the Social Security. Now the interest on the debt's been low. Since you were born, it's been low. But now the way the debt's going to go, look at the income projection now. Here's Social Security. Discretionary spending is going down because you can't do it. We have too much other debt and other mandatory spending. Revenues. Now, I want to show you this. Here's 20, and it cut down. I was very much against President Trump cutting the taxes, changing the tax law in the December of 2017. I do not think it should have happened. As you can see what will happen, trillions of revenue over the next 10 years. And now it even is highlighted because of the pandemic and what's happened. Now, let's go back. I asked you to look at sources. So let's look at a pie chart. If you just did a Google search, pie chart of U.S. source income, and I hope you'll put these in your head. 48% individual income tax, payroll tax, and 9% corporate. Pie chart of U.S. outlays. Here's where the money goes. Education, housing, emergency, science, labor, science, food and agriculture, transportation, veterans, homeland security, defense, and there's off the books here. There's off the budget money spent on defense too that you don't ever see there. Social Security, and health. So most of it's paying, you have, 50, 60 million people collecting Social Security and Medicare, with his health insurance for older people. So you are going to deal with budgets where you work, your government, all these things affect your life. So this is probably one of the most important chapters, these next two in the book about budgeting. Now, I would like to share with you, we have deficit spending where you're allowed to spend more than what you bring in. But here's the San Antonio budget, and I just wanted to share with you. You see here, you can't do that. Other city governments and everybody else, they can't do that. 1.29 million money coming from, 1.29 million spending. You can't have deficits in other places, companies can have a little bit, but most companies and most governments, city governments, state governments, they can't have deficit spending. We can't spend $1 more than what we bring in. All right. And we're blessed here to have an interest in city public service. We get a lot of money from there, property tax, the sales tax. And as you can see where it goes, public safety. That's why, we have these strikes with the police and the firemen and things like that. That's where a lot of our money goes. Parks and recreation, tiny slice, and and streets and infrastructure. Okay, so let's go back to our homework now. Let's finish this. So here, I'm going to bring up this table. And here it is. I want you to go all the way back to 1935. Social Security started in 1935. And I want you to know, what is the percentage between individual income tax and corporate? Individual income taxes, corporate income taxes. So when you add those two together, and you can see Social Security income is very small, like 3%. So if this add these three up, it's about 1,060 or so. And this is 50%, a couple of percent. And back then you had excise taxes and some other taxes. So now let's go now. 85 years later, here we are here, 2019. We don't want to use estimates. So now look at individual income tax. 50%, 51. Corporate, 9%. And Social Security is now 34. 34. Now, if I take these numbers and just highlight them here, and we want to say, we're going to just insert and graph, and we're going to insert a pie. And we put in the data labels. 9% corporate, Social Security, and individual. Okay, so 34% Social Security and 50 there. And what was it a minute ago? What did we look up? Payroll taxes, 34. So we just did this ourselves. We just did it ourselves by going to historical tables. And we came up with the exact number they have for the corporate income tax. Okay. So there we are with the exact number within 1% here, and we're a couple of points off here. So we just did that by going to the budget, Office of Management and Budget, bringing up a historical table, taking the data, create our own. So y'all can use this all your life to find data and information. All right, let's do our homework. Number 1, we predict the following sales for the next 2 months. So what's the sales for next month? Budgeted sales. Next month's budgeted sales. Well, we're going to sell 270 because we're doing May. So this is June. And what do we need at the end of the month? The ratio. We need ratio. And then what about here? Budgeted sales. Okay, so now we want 50% at the end of the month. So we need to have 135 of those. So this is what we want at the end of the month. Budgeted ending inventory. We're going to sell 270, and they want 50% of next month's sales. You're going to sell 270 next month, so you want 50%. So 270 divided by 2 is 135. Plus, what are you going to sell in May? 230. All right, so add budgeted sales for the month, 230. So how much inventory do we need all available? 365. So that's what we need for this month, May. Plus, you have ending inventory to start ready for June. What are we going to subtract from that? The beginning inventory, which is April, and you had 115. So 115 from that. And let's see, 365 is 265, 250. 250 plus 115 is 365. All right, there's a production budget. Direct materials. So we're going to produce so much. Well, now we need materials. Well, this is July. So July, we're going to produce 4,900. Well, how much do we need? We need 3 pounds of materials for each one. So we got to multiply the material requirements per unit, which are 3 times 1,400 is 12, 13, 14, 7, right? 12, 13, 14, 7. Now, what else do we need? 14, 7, plus you need the ending inventory. Well, what do they want at the end? They want 30% of next month's materials requirement. Well, what are we going to sell next month? We're in July, so what are we going to sell in August? 4,500 times 0.4 is 1,800 times how many pounds per unit? 3. So you need to have 5,400 on hand at the end of the month to help take care of August. So we need 20,000 pounds all the way. What are you going to subtract from that? Your beginning inventory, what you already have, less the beginning inventory. What do we have? The company has 4,400 pounds of materials at the end of June, 4,410. So we have 4,410, we subtract from that. So let's see, 20,100 minus 4,410, 690. And how much do they cost? What's the price? Price per pound, there it is. It costs $7. So you need $109,000 for materials. For production, you need to produce 250 on that one. So now we need 109,000 here. Well, now that's materials. Well, what's the big three? Labor and overhead. Remember the big three of manufacturing? Overhead, labor, materials. So you have a budget for each one. So now we did the materials. Let's do the labor. The budgeted production is 7,900. Well, how many hours you need? You need, let's see, how many hours you need per each one. Labor requirements per unit. They need 4 hours. And 4 times 14 is, let's see, 16 is at 19.6. 16, 17, 18, 19, 6. And how much you're going to pay per hour? You're going to pay $13. So you need $254,000 for this. Now you see how it's helping you plan? How much you need for materials? 109,000. How much you need for labor? 254,000. So you're starting to see your money requirements. That's why the budget is a great planning device. I mean, it's your Bible. All right, let's try the next one. Overhead. So materials, labor. Now we're going to do overhead. So now we're going to produce, and remember in overhead, you have fixed and variable overhead. What is fixed overhead? Insurance, property taxes, they stay the same. So we'll put that down here. Let's see if I can put budgeted fixed overhead. But let's do the variable. So then we have budgeted variable overhead. How much is the budgeted variable overhead? What is it based on? It's based on variable overhead. It's supposed to be 70% of direct labor cost. So we have to find our labor, total budgeted labor. So how are we going to get that number? How are we going to get that number? Each unit requires 4 hours of labor at 13 per hour. So next month, we produce, we're in August, so we're at 4,500 units. 4,500 times the 4 is 18,000 hours times the $13. So we need $234,000 of labor for August. And our budgeted overhead rate is going to be 70%. And 70% of that is 163.8. So we're saying for every dollar of labor, we spend 70 cents in variable overhead. For every dollar of labor, we spend 70 cents. We spend $1 of labor, 70 cents overhead. $100, $70. Plus our fixed overhead, they give us, and there's our budget. So you just finished doing the big three: materials, labor, fixed factory overhead budget. All right, let's try another one. The receivables. All right, so here for June, we're going to sell $500,000 and 388. The sales are 70%, 15% of the credit sales. Let's see, cash sales are 70. So in the credit, 15 are collected the same month, 7 are collected, and then 15. So 70, 80, 90, 100. All right. So the thing is, the credit sales are how much? If the cash sales are 70, what are the credit sales? 30% of that. So it's 150. So, and then over here, it's 388 times 0.3. So the credit sales are 106,400. Now, as of July, this is June. So in June, how much was collected? 15 per collected same month. Okay. And then as of July, another month, and 70 in the next month. So 15 in June, 70 in the next month. So they've collected 70, 85. So there's still 15% uncollected, and 15% is 22,005. All right, and down here though, this is July sales. So in July, at the end of July, the first month, you only get 15% collected. So it's 85% uncollected. So 0.85 times the 116,400 means we haven't collected 98,940 at the end of the month. Oh, let's see if we're right. All right, very good. Thank goodness. This is second or third time I've done this. The first time, I don't know why I didn't change the screens. I've had to do this all over again for you guys. Okay, cash budget. The cash budget is an important one. You got to know where cash came from and where it went. So they give us the beginning. We got 44,000. In the sales are going to bring it. We're going to collect another 257. So we're going to bring 301,000. But where's the money going to go? Where's the money going to go? So first, you got 1,500 on an interest bank, and then 10,2 going out for accrued income tax, and then 54,000 for some other expenses, and then 3,100 direct labor of depreciation. Depreciation is a non-cash. There's no cash goes for depreciation, so we don't include that. What's the journal entry for depreciation expense? Depreciation expense, and what else? Accumulated depreciation. It's a non-cash expense. It's a cost recovery. You're recovering the cost, so there's no cash going out. Nobody writes a check for that. So now the materials is the only hard one. These are all given to you other than materials. So you got to go figure out. Materials are purchased on account, and for August, you're going to buy 75,000. In September, 102. Payments are made 70% in the month of purchase and 30% the month following. So this is September. This is September. So if you bought it in August, 75,000, you bought 75,000 and you already paid 70%, we're going to pay 30% in September. Plus, we're going to pay 70% of the 102 we bought in September. So that's 93.9, I think. 93.9. 93.9 is what I think. So let's just see here. All right, thank goodness. All right, cash receipts again. Y'all should be able to do this. Following sales, August, September. Cash sales are 50% of total sales. And credit sales, and all credit sales are expected to be in the next month. So if the cash sales are 50, how much is the credit? 50. It has to be 50% as well. And all the 50% come in the next month. Okay. So they want to know for September. If in August you sold 120, that means 50% was cash in August, and the other 50% comes in the next month. So that's 60,000 if I'm thinking right. Okay. And of September, you're going to sell 210, and the cash sales are 50% of the total, and all the credit sales are the next month. So that means you collected 105 that month. If I think so, half of this is cash that comes in here, and then half of this was credit from August, and the other half comes in here. So let's see if I'm right. Oh, thank goodness. All right, let's go on. Okay, no, that's the same thing. The only difference is this percentages come in 55. So y'all should be able to figure that one out. Cash receipts with uncollectible. Guitar shop reports following sales, August 180, September 220. The sales include 30% cash, 55% credit, and 15% written off. So prepare a schedule. So the cash receipts from August, but we're doing September. We're doing September right here. This is August. 30% came in that month, 55% in the month following. So I think of the 180 for August, I think 55% came in the next month, or 99,000. $99,000. 55. Okay, let me make sure. 180 times 0.55 is the 99. And then cash receipts from September. In September, we sell 220 and 30% of that. So was that 66? 66 coming there. And that should, let's see how we did. All right, very good. Number 9, here we're making a loan. So you're preparing a cash budget and you need to borrow. So you got 12,000 on hand at the beginning of the month, and you anticipate 75,000 in cash receipts and 119,000 in cash going out. So right away, cash disbursements, cash payments, okay, they call it. So you're going to have 87 minus 119. So you're minus 32,000. You're short of money. So if you're short of money, you got to go borrow. And how much you got to borrow? Well, you need 32 just to be zero, but it looks like they want to maintain a $6,000 balance. So how much you got to borrow? And then that'll give you the 6,000. 32, okay. And let's see how we did. All right. Number 10, beginning cash balance, cash receipts, cash payments, materials. All right, y'all should be able to do that one. What's the first thing? Start off with the beginning, right? Right. So you put your beginning cash balance. What do you add to that? What do you add? Cash receipts, and that'll give you how much cash available. And then you're going to have, you have money going out for materials, money going out for labor, money going out for other expenses, money going out for your bank loan. So cash coming in, be cash available, cash going out, and that'll tell you what you have at the end of the month. Where's your ending balance? There you go. So y'all should be able to figure that out. Cash payments for merchandise. All right, so they purchased 650 in August, expect first September. Purchase materials are paid as follows: 20% in the month of purchase and 80% in the following. So if your sales were 650 in August, what percentage are you going to pay in September? You pay 80% in the following month. So 80% of that 650 is 52,000. In September, you bought 690 and you pay 20% of that in that month. So you got 20% of that number goes here. Okay. So let's see. See if we did it right. Cash payment for August. So 650 of August and 650. And you're going to pay 80% in the next month. And they're saying they don't like it. So you bought 650 times 80% in the month, August. You're going to pay that in September. So I just think they're wrong. Oh, 520. What did I do? I forgot a zero. There you go. I was off by 0. There you go. Next. Raider X forecasts sales of 13,000, computing the purchases. Now, y'all should be able to do this. Forecast 13,000 of units for April. Beginning inventory is 2,800. The desired ending is 30% higher than beginning. How many units should they purchase? So you got to figure out the budgeted sales in April, and they want to do 13,000. And what are you going to add to that? What you want at the end, and minus what you already have. Okay. Should be minus. Is it this? Yeah. So you're going to subtract. Let's see. So why is it beginning inventory for the month? So you want to sell 13. You already have the unit, the beginning inventory units for April. The beginning inventory is 2,800, and the desired inventory is 30% higher than the beginning. So you want the ending to be 30% higher than this one here. Okay. The purchase budget. Well, isn't that what we were just doing? Computing purchase, computing purchase. All right, well, we'll finish this one for y'all. So right here, you want the budget inventory. So 2,800 times 1.3. So at the end, I want 3,640. So then we have 16,640 minus 2,800, which is the beginning, is 13,840 that I need to buy. And if I buy 13,840 plus the beginning, I got about 16,640, and we sell 13, we'll have 3,640 left, and that's 30% higher. Let's just check. All right, very good. So if we did that purchasing, y'all can do this one here. And let's see, 14, manufacturing materials. All right, so let's talk about this just for a minute. The plans for finished goods inventory of 200 at the end of June. They want the budgeted in an inventory to be 200 at the end of June. See right there? The company wants 200 in June. In addition, each finished unit requires 5 pounds of direct labor. No, got to start over again. Material requirements per unit. 5 pounds, 5 pounds, 5 pounds. So now we got to multiply this. 25, that'll be 2,600. And 3,000 is just 3,250. And 3,000 would be 3,100, right? Okay, that's what you need. All right, so now, plus you want the budgeted in inventory. So how many pounds you want at the end? Here you want 200, fine. Now, how many you want at the end of months? Each finished unit requires, the company wants to end each month with materials equal to 30% of the next month's production needs. Okay, so at the end of this month, you want 30% of that here. And at the end of this month, you want 30% of that, okay? Does that make sense? 3,100 times 0.3. So at the end of this month, you want 930, which is 30%. And then the month before, you got 3,250 times 30%. So here you want 975. So your materials, you need that many altogether. Well, what do you always subtract? What you have at the beginning. Materials at the beginning. So what do we have at the beginning? Let's see. The beginning direct materials for April was 780. So here we go. 780 is what we have. So it's subtracted. I don't have to put a minus. So then, and don't forget here, what's the beginning for May? The beginning on May 1st is the end of April 30th. So on April 30th, you have 975, and at the stroke of midnight, it's May the 1st. So your end of this month is the beginning of that month. The end of May is the beginning of June. All right, now, what do you have to pay per pound? Let's see. Wow, where's the pounds? Materials cost $2 per pound. So 2 and 2, and that fills in. Let's see how we did. Budget in an inventory, pounds. Let's see. The company plans for finished goods inventory of 200 units. And what did I fail to multiply by? Each unit has Each unit requires 5, so that should be 5 times 200 is 1,000. Let's just see if that's a mistake I made. So I put here, I convert it to the units. I mean, from units into pounds, and I check that. At the end of June, the company plans for finished goods of the 10th end of June. In addition, each unit requires 5 pounds, and the company wants each month with direct materials, 30% of next month's production needs. They want equal to 30%. So they at the end of June, they want July. So the production is 620 for next month times 0.3. So they want 186 units times the 5 pounds. So let's see. So here I was thinking it would be this, and it's the next month. So let's see now. All right, very good. Direct labor and factory overhead. Direct labor, factory overhead. Now, we just finished doing that, so you should be able to do this. Budget production. What are you going to do? The company plans for finished goods of 200 in each unit. And the labor, total labor, each requires 0.4 of labor. So each unit requires 0.4. So here are the sales, 520, 520 production, 650 this. And each unit requires 0.4. So you're going to need 0.4, 0.4, and 0.4 hours. Each one needs 40% of an hour. So that's how much time they need. So so now you're going to have to take 520 times 0.4. So you need 208 hours of labor there. And here you have 650 times 0.4. You're going to need 260 labor hours there. And for this here, 0.4 times 620, you need 248. And what do you have now? They want to know the budget of labor. So if you need this many hours and they want to know the total labor, what would you have to multiply by? Your labor rate. And their labor rate is their labor, direct labor, up to 24, 24, and 24. All right, now you just have to do the same thing for materials. What is this now? Factory overhead. They want you to do and it's based, the overhead budget's based on this. So these labor hours that you have here, 208, 260, 248, 208, 260, 248, you bring them over, and what are you going to multiply by? What's your variable overhead rate? And that'll give you your budgeted variable overhead plus your fixed. Okay. And I gave us the company budget variable rate at 28 per direct labor hour, and budget fixed overhead are 8,800. So that one's given to you. So you got to finish that. Let's see how we did. Okay, so that's right, and these are right. So now you have to figure out that budgeted labor rate, okay? All right, let's see what's next. Preparing production budget for 2 periods. You can do that. You're gonna do, again, the projected budgeted sales for each quarter. So here it says here, second and third. So you got to go find the second and third quarters. There it is, there's the second quarter. And required units. So what do they want you to have? What do they want? Ending inventory. Company probably calls for ending finished goods at a quarter to equal 30% of the next month. So the ending is 30% of that number. 30% of that number right there. Okay. And here you're going to need 30% of the fourth quarter. So that's 358.5. And then minus what you already have produced, your beginning inventory. Okay. Beginning inventory, and that you got to produce what you don't have. Okay. So now direct material, direct labor overhead. So now they just want you, look, it's all filled in for you already. Direct material, the big 3, materials, labor, overhead. I don't know how many times. Materials, labor, overhead, the big 3 of manufacturing. It's all laid out for you. You just got to fill in the numbers. Okay, very good. I really hope this helped you. And look, you're going to deal with budgeting in your life. Please trust me, believe me, you're going to deal with budgeting. Okay. All right. You have a great day.